Good morning, friends. Let's start writing the summary first. Which was the last topic we wrote the summary? Topic 47. Okay. Now write leading and lagging. Topic 48, leading and lagging. Leading and lagging. Leading and lagging. Question number 1. Leading and lagging. Leading and lagging. And lagging checks whether. Leading and lagging checks whether we should make or receive. We should make / receive. Make/receive payment. We should make / receive payment today or later. Payment today or later. Full stop. The underlying principle is that we should opt for an alternative. We should opt for an alternative having lower outflow of INR. Having lower outflow of INR / higher inflow of INR. Having lower outflow of INR / higher inflow of INR. Next, question number 2. No special adjustment. Question number 2, no special adjustment. Question number 3, no special adjustment. Even 3, 4, no special adjustment. 2, 3, 4, no special adjustment. You can just mention one more point. Question number 4, comprehensive problem to revise leading and lagging. Question number 4, comprehensive problem to revise leading and lagging. Question number 5, point number 1, the company has an option of paying today. The company has an option of paying today by taking an INR loan. Full stop. 18% per annum with quarterly rest. 18% per annum with quarterly rest. 18% per annum with quarterly rest. With quarterly rest would mean that there would be a quarterly compounding of interest. Next point, for the foreign currency loan, we will have to give a letter of credit. On which commission is to be paid. Next point, commission is paid on day 0. Commission is paid on day 0, whereas commission is paid on day 0, whereas the final outflow to the bank happens after 180 days. Final outflow to the bank happens after 180 days. Full stop. These two numbers cannot be added. Cannot be added due to time value of money. Concept. And hence we will charge additional interest on commission. So that the final outflow is calculated. Topic 49, netting. Point number 1, the common currency given in the question is pound sterling. Next point, we will have to convert all cash flows into GBP. Into GBP so that the various exposure can be added slash deducted. Next point, find the net exposure. Find the net exposure and find which company and find which subsidiaries have to make slash receive the money. Which subsidiaries have to pay slash receive the money. Next, question number 2. Point number 1. The focus of the problem is to decide on whether the conversion of GBP into INR, conversion of GBP slash USD, conversion of GBP slash USD into INR. Just a minute. Conversion, what have I written? Conversion of GBP or USD into INR. Can you just read the sentence?
The focus of the problem is to decide on whether the conversion of
Okay.
INR
INR should happen on day 0, should happen on day 0 slash day 30, should happen on day 0 slash day 30. Should happen on day 0 slash day 30. Next point, conversion on day 0, conversion on day 0, conversion on day 0 would mean centralized cash management, would mean centralized cash management, would mean centralized cash management, and conversion on day 30 would mean independent cash management. On day 30 would mean independent cash management. Would mean independent cash management. Next point, calculate the final cash flow, calculate the final cash flow, calculate the final cash flow in terms of INR, final cash flow in terms of INR, in terms of INR, and then decide on in terms of INR, and then decide on method to be selected, and then decide on method to be selected, and then decide on method to be selected. Next, question number 3. Question number 3. The question talks about 4 transactions. The question talks about 4 transactions. About 4 transactions. About 4 transactions wherein 2 transactions will be knocked off against each other. Wherein 2 transactions will be knocked off against each other. 2 transactions will be knocked off against each other. Next point, for the other 2 transactions, there is a timing difference. There is a timing difference of 90 days. There is a timing difference of 90 days. There's a timing difference of 90 days. Next point, the company can go for the following ways. The company can go for the following ways of hedging the transaction. Can go for the following ways of hedging the transaction. Point number 1, using a forward cover. Using a forward cover. Using a forward cover. Point number 2, creating an euro deposit. Creating an euro deposit. Point number 3, creating a GBP deposit. Creating a GBP deposit. Next point, select the alternative. Select the alternative having lower outflow. Select the alternative having lower outflow. Having lower outflow. Clear? I'll now continue with forwards. How many questions we have done in forwards? We are done till 8. Just a minute. Okay, we'll continue with forwards. I'll just summarize a little bit of it, whatever we have done till now. Now, forward is basically a transaction done by the company to ensure that there is a certainty of outflow or inflow of INR. If I have to receive $1 lakh, I convert that $1 lakh as 62 lakhs, 63 lakhs, 65 lakhs, 67 lakhs. Everything happens on day 0. So what forwards does is it becomes certainty to the transaction which we are doing. Because when a company does a transaction, when I'm selling my product, I'm selling it at $1 lakh because I feel that this $1 lakh will get converted into 65 lakhs. But instead of receiving 65, if I receive 62, 63, it's going to be a loss making transaction for me. So I need certain ways of covering my transaction. In that we learnt about currency invoicing, leading and lagging. Now we are learning forwards, then you learn futures. You also have something called as money market. So there are multiple ways. So forwards was one of the ways. Now the focus of forwards was these. There are 3 ways in which a forward contract will get closed: cancel, honor, extend. Cancel, honor and extend. In all this we have seen 3 scenarios. This can happen on due date. For all the 3, the breakup was it can happen on due date, before due date, after due date. That is on time honor, on time extension, on time cancellation, early honor, early cancellation, early extension, late honor, late cancellation and late extension. So totally 9 possible ways were there. Of that, there's only one way of honoring your commitment, which is honoring on due date. Everything else is going to involve a cancellation, and for that we had to do something called as a cancellation profit or loss. The format which we had used was date, position, action, reference date, rate. This is the format we had used to find out the profit or loss on cancellation of a contract. On what date are you entering, whether it's an original position, opposite position or a new position. There are 3 types of position. Either it can be an original contract or an opposite position or a new position. Action can be only to buy or sell. Reference date will depend on this date and action. Sorry, reference date will be given in the question. The rate will depend on date, action and reference date. On this date, for this reference date, to buy or sell, what is the rate? That's how we read it. So this is what we had done in the last class. I'll continue with that now. Let's go to question number 9. NP and Co has imported goods for $7 lakhs. The amount is payable after 3 months. The company has also exported goods for $4,50,000 and this is receivable in 2 months. For receivable, a forward contract is already taken. The market rates for rupee and dollar are as under: spot 2 months, 3 months. The company wants to cover the risk and it has 2 options: cover payables, lag the receivables and cover risk only for the net amount. No interest. Evaluate both the option. If rupee fund cost is 12%, which option is preferable? Okay, now coming to this question, they've given details. What it is suggesting is, I have done an import of some $7 lakh, and I have also exported goods worth $4,50,000. But this 450 is going to be received in 2 months. This 7 lakh is going to be received in 3 months. This export, I don't know when it had happened. It could have happened earlier also. What had happened is, when I have done the export, I have also covered it through a forward contract at the rate of 48.90. Now I have two options. I can cover the entire $7 lakh in the forward market. So when I cover entire $7 lakh, day 0 I will cover the transaction and keep quiet. At the end of month 2, I will receive some money. I'll receive some money. That money is basically 4,50,000 into 48.90. Rate has already been fixed. After receiving that money, I'll create a fixed deposit, because month 2 and month 3 cash flow cannot be added. Cash flows at different points of time, you cannot add it. So ideally what you will do is, you will either create a FD or reduce the loan. Either you create the FD or reduce the loan which the company currently has. In this process, either you save interest at the rate of 12% or earn interest at the rate of 12%. Something will happen. At the end of 3rd month, some money will come. So first, what I receive in the 2nd month, second, the interest which I earn or I save, and minus payable. This is my net outflow for the option 1. Option 2, what they are saying is, you don't do anything as of now. Please don't do anything. What you do is, cover entire 3 lakh itself. Second option is, cover only the net amount 2,50,000 by delaying your receivables. Don't collect the money from your customer, delay it. In this process, what has to happen is, I have to first cancel 4,50,000 contract. Cancel 4,50,000 USD contract. On this, there will be a cancellation gain or loss. That will happen on day 0. To take it to month 3, I can add interest or ignore interest, because it's going to be an insignificant amount on the cancellation gain. Institute has not considered it. So the basic rule is, when do I consider interest is, cash flows at different points of time should not be added. So when you are adding something, you keep asking yourself, is it received in month 3? Is this amount also in month 3? Is this amount also in month 3? Everything is month 3 added. If something is month 1, something is month 2, something is month 0, ideally you cannot add them. So if you cannot add them, you will have to take the help of interest rate. If interest rate is not given, you kind of add it, because interest rate is not given, you ignore that part. So for the second scenario, I'll calculate cancellation gain, and at the end of 3rd month, I'll pay only $2,50,000. How 2,50,000? I receive 450, don't convert it, and pay the $7 lakh. When I have to pay the $7 lakh guy, I use this 450 and add another 250. Clear? Any doubts in this? Now, evaluation of option 1. Evaluation of option 1. Particulars calculation amount. Particulars calculation amount. Evaluation of option 1. Particulars calculation amount. Now, the first thing which we would have done, I would have covered the payables in the forward market on day 0. When I cover the transaction, no outflow, no inflow. So let's not write it. When will be the first outflow or inflow happen for option 1? Covering payables in the forward market. At the end of 2nd month, you will receive the money from your customer. So receipt in M2. Receipt in M2. How much is that? 4,50,000 into, the rate is already agreed on. 220.05 lakhs. Let's write it in lakhs itself. $220.05 lakhs. What are we going to do with this 220.05 lakhs? Two purpose, either you create a deposit or reduce a loan. In both ways, you are going to reduce either your interest expense or increase your interest income. In both ways, there is going to be a benefit to the company. So next, interest saved slash earned. Interest saved slash earned in M3. Interest saved slash earned in M3. 220.05 into how much? Into 12% into 1 by 12. This is only for 1 month. $2.20 lakhs. The basic rule is you cannot add cash flows at different points of time. So keep that rule in mind. Cash flows at different points of time can't be added. So wherever you want to add them, take the help of interest. Next, payable. $7 lakhs into, tell me at what rate this agreement would have been entered on day 0. 7 lakhs into how much? 48.5. No, how will it be 48? On day 0, at what rate you would have entered the agreement to be? Yeah, please participate. I'm not able to hear properly. 40? It's not 48. It's 49.15. The calculation is very simple. I don't know why we are struggling. 48.70 ascending order, you will have to add 45 to it. 48.70 plus 0.45, 49.15. It's in the ascending order. These are basics. I don't expect you guys to struggle with this. Please be very clear. These are basics. I have told you if they are in the ascending order, you will have to add it. This rate is freezed on day 0. Purposefully in the question they may give at the end of month 3 the rates are this. I'm not bothered about what the rates are at the end of month 3. For me what matters is what rate I agreed on. When I write receivables, I did not even check what was the 2-month rate. I told directly multiply with 48.90 because we have already entered an agreement. When I have entered an agreement, my rate is freezed. So let's not bother about, let's not complicate stuff by looking at information which is irrelevant. Your forward contract was entered on day 0 and it would have been entered at the rate of 49.15. They will purposefully give some information which is, for example, this spot data is of no use in this question except for one thing, for adding purpose, saying that it's in the ascending order, I'll have to add it to the spot rate. Otherwise that spot rate in this question has no relevance. Any doubts on 49.15? Why ask rate? Because I have to pay it. Wherever payable is there, higher rate. Wherever receivable is there, lower rate. So keep that in mind. So it's easier for you to proceed. Into 49.15. $344.05. This is my payable net outflow. $121.80 or something. 121.80 lakhs. This is my option 1. In option 1, I am paying 121.80 lakhs. I'll evaluate option 2 and check how much are we paying in that. So the net outflow is 121.80 lakhs. Any doubts on this? Can we? Clear? Next, evaluation of option 2. Evaluation of option 2. Point number 1. Evaluation of option 2. Point number 1. The company is planning to go for hedging of net receivables, net payables, hedging of net payables, full stop. This would mean that we have to cancel. This would mean that we have to cancel the existing forward contract. Cancel the existing forward contract. And take a FC cover. For net payables. Take a FC cover for net payables. Clear? Next, calculation of cancellation gain or loss. In that part 1 is I have to get the cancellation gain or loss. Now I'll again be explaining what we have done earlier. Don't try to complicate stuff. Go step by step. It will be easier for you to follow. What are the 5 columns? Date, position, action, reference date, rate. Now I've already entered into a contract. I don't know the date, so I'm not bothered about it. I'll write it as original date. Let's call it as original date. We don't know the date, on what date this was entered and all. Original date. Position is called as original date. Position is original. Whether it was to buy dollars or sell dollars. What has already been entered in? Let's not bother about the 7 lakh wala part. What is already entered is buy or sell. Sell $450,000 at the rate of 48.90 after how many months? 2 months. So now please listen. Sell 2 months 48.90. Sell 2 months 48.90. This is what we have already done. Sell at the rate of 48.90 after 2 months. Clear? Any doubts on this? Now I have to cancel this. Cancellation is today. Today we are doing the cancellation. Today. Position is called as opposite. Action will be buy. Most important thing, these two has to match. These two has to match. What is what is the 2 months buy rate on today? What is 2 months buy rate on today? That's the requirement. Read it and tell me. 2 months buy rate on today. How much? 49, 48.70 plus 0.30. What is today's, sorry, what is 2 months buy rate on today? Any doubts in this? Any doubts in this? So this is 49, buy means in brackets, loss. There can be a gain, there can be a loss. In this problem, it's a loss of 45,000 rupees. We're going to lose 45,000 rupees because of this change. Loss is 45,000. Any doubts in this? Can we proceed? Next, listen for a minute. We have to do something like this. There will not be receipt in M2. First thing is cancellation loss in M0. To take this loss to M3, interest cost on the cancellation loss. Why interest cost? Institute has not taken it, but let me take that loss, cost whatever it comes out to be, and I'll have to take it to month 3. 45,000 of day 0 cannot be added with what you pay in month 3. That's what finance says. Finance says cash flows at different points of time can't be added. You want to add or subtract them, use the question of interest. So we are going to do that in this question. Clear? Let's start. Calculation of total outflow. Particulars calculation amount. Particulars calculation amount. Point number 1, cancellation loss. It will be good if you can write the time period in between in brackets so that you will understand some things can't be added. Cancellation loss happens in M0. 0.45, 0.45. It happens in M0. M0 means today. My loss is going to be calculated today. Any doubts on this? Point number 2, interest on cancellation. Interest on cancellation. I have to pay this interest on cancellation of 0.01. Any doubts on this? What will be the third item of outflow? All these are outflow. There is no inflow in this option. What is the third outflow? Net payable. I'm going to receive $4,50,000 and I have to pay $7 lakh. No, I'm not going to do any conversion of 450 because I lose the bid and ask difference. So, payable in M3, 2.5 lakhs into what rate? You just check and let me know. It would have been entered in day 0. 2.5 lakhs into what rate? 49.15 into 49.15. Now we'll have to decide which alternative is better. Which is better? Alternative 1, that is covering the entire payables in the forward market. No point of cancelling and doing all of this. You go ahead and cover the entire payables in the forward market. That's the advice we are going to give to the company. Any doubts in this? So you can write a conclusion. The company should go ahead with covering the entire payables in the forward market. Covering the entire payables in the forward market. Any doubts? Can we proceed? Yeah.
In this question, they have not mentioned when are we cancelling.
The assumption is I'll cancel it immediately. If I have to cancel at the end of month 2, then I need the rates on those days, which are not there in the question. When you cancel at the end of month 2, so they'll have to mention in the question saying that the company plans to cancel the contract in M2 and the rates on those days were as under. Because I need those dates. For cancellation purpose, then you would write it like this. Instead of today, you would write here month 2. Then my question was, what is month 2's rate in month 2? What is month 2 rate in month 2? So that you need information. That's not there in the question. So the normal assumption is you will go ahead and cancel it immediately. When a cancellation is known, you cancel it immediately unless the problem provides otherwise. The question could have made it saying that the company plans to cancel at the end of month 2. In month 2, the rates have turned out to be this. Let's do question number 10. Go through the question. Okay. Now coming to this question, I had entered into a contract for how much exposure? $1 lakh. I get to know that I have dispatched goods worth only 70,000. So I would have entered into a contract on day 0. I may get to know about the 70,000 dispatch in between. I don't know when I get to know about it. Is it immediately or after 2 months, after 3 months, after 4 months? No information is there. The moment I get to know it is 70,000, I should go ahead and cancel the part contract. I should go ahead and cancel the part contract. In this question, we are not aware when this 70,000 dispatch has happened. So we are going to do it in 2 stages. One stage is you will receive $70,000 and realize the rate at the forward contract rate which you have agreed on, and cancel $30,000 at the end of month 6. The cancellation will happen in the end of month 6. Why month 6? You do not know when do you know that the 70,000 dispatch has happened. That information is not known. It cannot happen on day 0, because if it's day 0, why will I take a contract for 70,000? I had entered into a contract with somebody on 1st January that I will sell $1 lakh. Immediately I cannot know that I have sold only 70,000. So practically whenever I get to know it is only 70,000, I'll go ahead and cancel it. This problem, the cancellation will happen at the end of month 6. Clear? So I'll have to get cancellation gain or loss at the end of month 6, and receivables at the end of month 6, both can be added together because both are in M6. If it was not in M6, you will have to take the help of interest. If interest rate is not given in the question, you will write a note saying that it is assumed that there is no interest receivable or payable on the cancellation gain or loss. That assumption I'll have to take and go ahead. Working note 1, calculation of cancellation gain or loss. Cancellation gain / loss. Cancellation gain / loss. What are the 5 columns? Date, position, action, reference date, rate. When did I enter into a contract with the bank? Jan 1. This is original contract. On Jan 1, I have entered into a original contract. Originally was to buy or sell? Sell. For which date? 6 months later on July 1. On Jan 1, what is the sell rate for July 1? On Jan 1, what is the sell rate for July 1? On Jan 1, why will it be 50? 53.06, no? Those are points. 50, 60 is points. So 52.56 plus 0.50, it adds up to 53. This is the rate I have agreed on day 0. On day 0, I have agreed this rate. Unfortunately, I see a scope of cancellation for part contract. So let's do that cancellation. I come on which date? July 1, opposite by July 1. On July 1, what is the buy rate for July 1? On July 1, what is the buy rate for July 1? How much? Buy rate. On July 1, what is the buy rate for July 1? Straight away 53. No, why the confusion is? On July 1, what is the buy rate? Buy rate means ask rate. Buy is ask. If you are getting confused, then you better write bid rate and ask rate. You want to write it that way, you write it. I normally write it so. You can do it like this. Sell in bracket, bid, buy in bracket, ask. If at all this can help you in avoiding a little bit of a confusion. Sell means bid rate. I am selling, bank is buying. Bank will buy at the bid rate. I have only one rule. Wherever I buy, I take the higher rate. Wherever I sell, I take the lower rate between the two rates. So sell is bid rate, buy is ask rate. What is the ask rate on July 1 for July 1? Ask rate on July 1 for July 1. Ask rate 53. I see on July 1, I am asking on July 1, what is the ask rate? On July 1, what is the ask rate? Which is 53, no? Straight away. Yeah. Which one? How do you say it's the PIP portion? Understood. Can the rate be 52.53? Can the rate be 52.53? I understand your point. It's the PIP portion. I agree on it. But can it be 52.53? It can't be. So because of that, it's 53. Otherwise, what is... So if it was technically 80, then what you say is perfectly right. 52.80. But it can't be lower than my bid rate. That has to be always ensured. So it can't be 52.53 because of that reason. So Any doubts on this? Now, on the due date, this is my settlement. I'll go to the bank, give him $70,000. On that, he has to pay me something plus 1,800 he has to pay me, because this is my gain. He has to pay me 70,000 into something plus 1,800. So settlement is 70,000 into, at what rate the settlement will happen? Originally contracted rate 53.06 plus, this is what the bank will give me. The bank has to give me, I will give the bank $70,000. Settlement in bracket, you can put it as receipt. I'll receive 70,000 into 53.06.
Practically, when we've taken a forward cover for a certain amount, if there is part realization or part payment, will the bank honor it or will they cancel the entire?
No. Bank will honor. Bank is fine with whatever you do. Ideally, what will happen is, practically nobody does a transaction to transaction cover. It's impossible for me to do a transaction. I go ahead and say that I'll cover $1 million or $10 lakh, $5 lakh, $2 lakh, some amount which I feel is going to be realized over a period of next 6 months. As I realize it, I will ask for the honoring of that commitment. Some part of it may not be honored in the end. So normally companies don't go for hedging 100%. They go for hedging 70-80%. That's what most of the organization do, because it's difficult to predict when my customer will pay. So most of the times I'll honor my commitment, because the contract itself will be only for 70-80%. So ideally, if I'm going to receive 1,50,000, I'll take a cover only for 1,20,000 or something. So in that way, I will most probably honor my commitment.
That's if we are taking a forward cover, but in case of LCs, it's usually transaction to transaction.
So LC is only to cover, LC is basically an instrument. It depends on two types of LC, whether you receive LC or give LC. So assume you are importing something, you have to give LC to the supplier. Why an LC is given to the supplier is he is not able to trust you. The only reason why LC came into picture is he is not ready to trust us, but he is ready to trust ICICI Bank, he is ready to trust State Bank of India. So SBI gives an LC. In case of an LC, I know when my payable is going to happen. I am very sure that I have to pay $1 lakh at the end of 6 months. Either I honor my commitment fully, or I have gone out of business. Basically, I am struggling. I am not able to pay my LC, so there will be devolvement of LC. My banker will pay, and banker will charge me the penalty on all of that. So LC is more or less, if you have to hedge your LC payables or LC receivables, you can go ahead and do it, because that is certain to come in. You have to receive something, you will be 100% sure that money is going to come in. I don't know whether you are paying it or your banker is paying it. Someone will have to give me $1 lakh. So in that case, wherever LC is there, at least I can go ahead and perfectly hedge my transaction. Non-LC, I'm dependent on when you guys are paying, when my suppliers are, when my customers are paying. So practically, you may not do the entire hedging. Now, the calculation which I have done is for the exporter. You will start doing as if he is an importer. When I say importer, original is not sell, original is buy. So you will have to redo the calculation now. The second part of the question, what would be the position if he has done a purchase of goods instead of sale of goods and was in a position to import only 70,000. Originally 1 lakh, but later on I have brought it down to 70,000. Try to do it. I have to pay 37,69,000. The format will guide you to the cancellation gain or loss. You will have to be a little clear on what is to be done. If the clarity is there, it will guide you to the solution. It is a little tricky, but if you are clear on the format, you will get to the solution. Any doubts on this? Clear? Can you proceed? 37,69,000. 70,000 into 53.50, that's the rate originally agreed on. 24,000 of penalty to be paid. We have made a loss on cancellation, so we have to pay 24,000. Overall 37,69 is to be paid. Can we go through question 11? Okay, now we are going to start problem on extension of contract. Extension, honor or cancellation, anything other than due date, everything involves a cancellation only. So when he is saying he is going to extend the contract, first we will cancel it and then extend. We are going to do it in the same, that 5 columnar format. In there itself the extension will be done. How will we do the extension is by using something called as new position. Original, opposite, cancellation gain or loss, and then we write the new position there itself. So let's start. Create the format: date, position, action, reference date and rate. Let's start with which day the contract is entered. July 31. It's just filling this format. It's extremely simple if you're clear on what to look at. July 31. What is the position? Original. Action. Did we want to buy or sell? Buy. Buy in bracket what rate? Ask rate. For which date? On July 31, what is the ask rate for October 31? 60? 66, no. On July 31, what is the ask rate for October 31? On July 31, don't go in and see the October 31 date. On July 31, what is the ask rate for October 31? And it will be 65, 66, exactly straight away number. These are not points or something. 65-66. So what is the ask rate? 66. We come on which date? October 31st. You come on October 31. Opposite, sell in bracket, bid rate for October 31. On October 31, what is the bid rate for October 31? 65.5. This buy rate I will put it in brackets. 65.5. Cancellation loss. This is 0.5. Cancellation loss is 0.5. Now we are not stopping at this stage. We are going ahead and taking a next set of contract. The next set of contract is on October 31. New position, buy in bracket ask rate. For which month do you want to buy? November 30. On October 31, what is the ask rate for November 30? 66 points. I'm putting in brackets. 66.75. 66.75. And what we do is we add this and this to get the effective rate. Effectively, what are you paying? Effectively, what are we paying? Which is 67.25. Effective rate. Effective rate is 67.25. You need not worry about that 0.5 in between. It is minus 66 plus 65.5 minus 60. All those three rates to be added. Wherever it is minus, subtracted. Wherever it is plus, added. Forget about in between this item. You just need to consider those three items. Minus 66 plus 65.5 minus 66.75. These three items to be considered. Effective rate is 67.25. Any doubts on this? Clear? Now, we have calculated cancellation loss. Just a minute. We have calculated this cancellation loss, but this is not the real loss for the company. The real loss is this effective loss. And what is effective loss is what rate you originally agreed to pay and what rate are we finally paying. What rate did we agree to pay? 66. And what rate are we finally paying? 67.25. So effectively I am losing 1 rupee 25 paise. 1 rupee 25 paise is my effective loss. That is through two stages. One is on cancellation, second extra 75 paise for the extension of the contract. So the real loss is 1.25. The question will keep asking what is the, they'll say what is the loss or gain due to extension. You both write both cancellation loss as well as effective loss. You can put 0.5 in bracket whatever R. How much is the exposure? Rupees 1,50,000. R rupees 3,75,000. So I'm going to lose 3,75,000 effectively, or 1,50,000 effectively. Sorry, 1,50,000 on cancellation. Effectively, the loss is 375. This is if the person comes on the due date. It really doesn't matter if he comes early also. The only scenario where the problem is going to happen is if he comes late. When he comes late alone, the calculation changes. That is problem number 15 and 16. Next, again, recreate the statement for the part 2. They are saying what would be the position if prior to 1 month of the maturity the company had come for extension. So he is coming little earlier. Instead of waiting till the due date, he comes earlier and says can be extended. Doesn't matter, we are going to create in the same format. So let's write it. July 31 contract, you write it. The only thing which I would want is do these sums at home so that you are once and for all clear with all of this. As you do more and more problems, you will find it is easier. It is not that difficult. Calculation of gain or loss. The issue which will always continue to be there is whether to divide, multiply, bid, ask. That is something which is unavoidable. As you do maybe more and more problems, you get better comfort. Now, when am I coming in between? 30th September. September 30. I come on September 30. Opposite. I'll ask what? Sell in bracket bid. On September 30, what is the bid rate for October 31? 66.25. On September 30, bid rate for October 31, which is 66.25. Any doubts in this? Here, in fact, there's a cancellation gain. Cancellation gain 0.25 rupees. 0.25 rupees 75,000. Then we come on which date? September 30 itself. I am saying new position. New is for what? Buy. And for which date I want to do this transaction? November 30. On September 30, what is the ask rate for November 30? 65.80. I hope this is clear. It's as you do, it will become easier and easier. Effectively, we are gaining 1,35,000. There's an effective gain of 1,35,000. Any doubts on this? The format will guide you to the solution. Be clear on the format. It will take you to the solution. Can we proceed? Clear? Any doubts on this? Anybody has any doubts on this? Go through question 12 and start putting it in the format. I don't have much to explain in 12. You will start putting it in that format. Go through and start putting it in the format. If at all you need any guidance, let me know. Let me know in case there are doubts. I don't want you to copy. Please be very clear on that. This is just for your reference. Wherever you are making a mistake, if you can understand, great. No, let me know your doubts. I'll clarify them. This is only to verify the solution. Any doubts on this? There can be a cancellation loss, but effectively you can gain. That is scenario 2. It's not necessary that both has to be loss or both has to be profits. One can be profit, the other can be loss also. Any doubts on this? Anyone needs an explanation, please let me know. It is not to copy. Again, I'm telling you, I don't want you to copy it from the board. If you need some guidance, let me know. I'll clarify that. Can we proceed? Any doubts? Can we? Let's move to question number 13. Let's go through the question. An importer requests his bank to extend the forward contract for US dollar, which is due for maturity on 30th October 2010 for a further period of 3 months. He agrees to pay the required margin money for such extension. Contracted rate, US dollar quoted on 3010 spot premium margin money. Cost to the importer in respect of extension, the rate of new forward contract. Now, my original contract was due on 30th October 2010. I come on that day and ask for extension by 3 months. They are saying cost to the importer in respect of the extension. Cost to the importer is nothing but cancellation loss or effective loss. They interpret in different ways in different question. We'll kind of write both the cancellation loss as well as effective loss. And rate of new forward contract is obviously the new rate which is agreed on. So whatever format we have, in that all this will come. Your cancellation loss will come, new rate will come, effective rate will come, your effective loss will come. So everything will come there. So let's put it in that format and then finally write these two things. So right, date, position, action, reference date and rate. Date, position, action, reference date and rate. Let's start with original date. I don't know on which date this was done, doesn't matter. Original date, original date, original position. What did this guy want to do? Buy or sell? Buy in bracket, ask. For which date was this? October 30. He had contracted this for October 30 and the rate which was contracted was 42.32 minus 42.32. Now this is with one assumption, okay? I assume this 42.32 is after all of this. This is an extra margin, is extra profit for the banker. This will be added to the ask rate and subtracted from the bid rate. So this is an extra margin for the banker. Now 42.32 is the original date agreed on. Then we come on which day? October 30. Opposite, sell. On October 30, what is the ask rate for October 30? On October, sorry, bid rate. 41.5. Now please listen, this 41.5 has to be adjusted for this. Now the only issue I have is whether to understand the buying rate from banker's point of view or from my point of view, because that makes a difference. When it is from banker's point of view, the buying rate is called as bid rate, the selling rate is called as ask rate. When my point of view, if I see, buying rate is called as ask rate and selling rate is called as bid rate. One thing which I am sure is this, with 41.5 I have to subtract. From 41.5 I have to subtract. The only thing is, do I subtract 0.075% or 0.20%? That's the only doubt I have. There I'll have to write an assumption. I have to write an assumption that it is interpreted that margin of 0.075% will be applied on banker's buying rate and 0.20% will be applied on banker's selling rate, or will be applied on client's buying rate and client's selling rate. That has to be very clear. So that is an assumption we are going to note down. We will take it as banker's buying rate and banker's selling rate. Now 41.5 is banker's buying rate or banker's selling rate? Banker's buying rate. So I'll subtract 0.075%. I'll subtract 0.075%. If you take it as client's assumption, then you would have subtracted 0.20%. We would have subtracted 0.20. This is assumption. We'll write the assumption in some time. 41.50 minus 0.075%. Any doubts on why we subtract? Because this is an extra margin for the banker. It is subtracted from the lower rate. It is added to the higher rate so that the margin increases for the banker. He makes more and more money. Tell me the two decimal number. 40. Clear? Any doubts on this? We will write this assumption in some time. This is our assumption. The assumption is, I assume that I am going to calculate all of this, that buying rate and selling rate margin is interpreted from banker's point of view. Cancellation loss, cancellation loss. This is not my overall loss. I'll come to the overall loss now and the new rate itself. We'll end up writing both. On October 30, what I am doing is new, and new is for which date? Jan 31st, 3 months. Tell me, how will you calculate this? 41.52 plus 0.93% plus 0.20%. See, simple rule is, when bank wants to collect anything from us, they'll keep adding lot of stuff. When they have to pay us, they'll keep deducting lot of stuff. That's the practical aspect. So they will add their margin to the, whenever money is to be collected from the customer, they'll keep adding all of this. When the money is to be received or money is to be paid to the customer, you do the other way around. So it's 41.52 plus 0.93% plus 0.20%. Finally, you get 41.99. I'll write it as minus 41.99. 41.99. 41.52 plus the premium plus any doubts on this? I'll come to the solution to the answer in some time. Now, in this question, instead of 3 months, okay, 3 months premium is fine. They make it as 0.93 and 0.87. They make it as 0.93 and 0.87. Does this make any difference to our answer? Will it make any, or the way of computation? If they make it as 0.93, 0.87, what will be the contracted rate? I'll put it this way. If it's 0.93 and 0.87. If the premium percentages were 0.93, 0.87. We have to? Why? We have to consider it as? Okay. Who said it is swap rate? Is it swap rate? Now please listen, Institute has purposely done this in one question. They made it in descending order, but they used the word premium. So premium means you'll have to again add only. They purposely made this in one question. They used the word premium, but gave it in descending order. People quickly will say descending order, I'll deduct it. No, the word used is premium there. So they purposely made this in one exam question. So be very careful about these aspects. It is points. If it is swap points, what you say is correct. 0.93 slash 0.87. If that is the word used, I perfectly agree on what you are saying. You have to deduct it. But instead of doing that, they will make it 0.9. 0.93 and 0.87 will not make sense in this question because your ask rate will become lower than bid rate. That is not going to make sense. But in some other problem, they will make it purposefully like this. The question will be made in the descending order, but when they are making it in the descending order, they will give it as premium. Premium means it has to be added only. Clear? Any doubts on this? Get the effective rate. I'll just come in a minute. this is called as effective rate. So effective rate is 42.84. Any doubts on effective rate of 42.84? Now listen. What is the effective loss? 0.52. Effective loss is 0.52. Any doubts on 0.52? Now let's answer these two parts. Cost to the importer in respect of extension. Cost to the importer in respect of extension, and underline that. After this table, cost to the importer in respect of extension. Now write the importer, make it like this itself so that we are giving both the perspective. The importer will have to pay a cancellation loss. The importer will have to pay a cancellation loss of rupees 17,000 into 20,000, 0.85 into 20. We'll have to pay cancellation loss of rupees 17,000. Full stop. However, the newly contracted rate in bracket 41.99, newly contracted rate 41.99 is lower than the originally contracted rate, in bracket 42.32, and hence the effective loss is rupees 10,400. Effective loss is rupees 10,400. Though I lost 85 paise, some recovery has happened because my new rate is lower than the old rate. So net what I lose is only 10,400. Any doubts on this? Next, part 2 was rate of new forward contract equal to 41.99. Rate of new forward contract equal to 41.99. Yep. Effective loss of 0. What is your effective rate you got? 94. The point is here you would have got a different rate, no? So effectively what is happening is it will be small rounding of differences will be there. Otherwise broadly the answer will match. Why it is going to be broad rounding of differences? In this case when you did 41.47, instead of doing 41.47 you would have done a little lower rate, something like 41.42. There the 5 paise is reduced and here the 5 paise is compensated, because both the rates are applying in your answer. So why it is exactly the same figure is because both the losses are applied on some 41 point something. If one rate was 41 and another rate was 60, you will not have such high differences in the rates. If there was high difference in the rate, you may see differences. If I do properly without rounding off, there will be some differences still in our both solution. Rate of new contract is 41.99. Now write the assumption. It is assumed that the given margin is for bankers buying and bankers selling rate. Given margin is for bankers buying rate and bankers selling rate. Bankers buying rate and bankers selling rate. Any doubts on this? Clear? Can we proceed? Go through question 14 and start doing it in the format. We'll spend some 5-6 minutes on this and then I go to the late extension, which will be the most critical part. Do question 14 quickly. Gain. It is positive. I have not changed this one. Let me know in case there are doubts anywhere. Any number is not clear, do let me know about it. If some number is not clear, please let me know about it. Now they have asked for extension charges. You will have to again write, the company will have to pay a cancellation loss of so much. However, the effective loss or gain will be so much. Extension charges is, please write both. Explain both, because sometimes institute has taken cancellation loss, sometimes they have taken effective loss. So it's better to write down both. The format is going to be a guide in most of the questions. Most of the questions you will be in a position to do it through this format. Can we proceed? Any doubts on this? Now I'll move to the last part of forwards. Any doubts till now? Any doubts on forwards? Okay. The last part is cancellation, but the cancellation is going to happen late. Late is after due date. Now I'll first explain from the theory point of view. Okay. Now, extension of a contract when a customer doesn't appear on due date. The first thing which you have to do is cancellation rate. Now, till now what I have been doing is, You see all the cancellation. This is technically a cancellation. The moment you write opposite, you are doing a cancellation of a contract. Any cancellation we have done, we have ensured that June 30 is cancelled with the June 30 rate. In case a person comes late, the cancellation will not happen on due date, because I still wait thinking that he may come. Practically, as per rules, I think you have to allow 15 days to the customer even after the due date. So I'm not sure whether he is going to honor his commitment or he is going to cancel his commitment. We are not sure about it. So a cancellation will not be applied on, let's assume the due date is June 30. Cancellation will not happen on June 30. The cancellation will happen on the date on which the customer appears to the bank. So if he comes on July 10, you have to take July 10 rate for cancellation. If he comes on July 15, you have to take July 15 rate for cancellation. The rules remain the same. March 31, original, buy, ask, June 30 minus 50. He comes on July 10, opposite, sell, bid and all remain same. But the reference date is going to be July 10, because on July 10, I cannot get the June 30 rate. On July 10, I cannot go back and say what is the June 30 rate. So on July 10, what is the July 10 rate? That is the cancellation rate. That's the cancellation rate. Clear? Any doubts on this? The date on which the customer appears, the first departure from the rule which I have been doing till now. I have till now always ensured that whenever I do cancellation, I copy the same reference date. This is the first problem where this reference date rule is not going to be followed. I am not going to follow this rule of the reference date. Clear? Any doubts till now? So the cancellation will happen as per the date on which the customer appears. So they have said spot rate plus margin on the date on which the customer appears for cancellation. Not plus margin, it can be plus or minus margin. If it's from the bid rate, the banker will deduct it. If it's the ask rate, the banker will add it. In short, you can just understand it as spot rate. You can understand it as spot rate, but spot rate on the date on which the customer appears. It is spot rate on the date on which the customer appears for cancellation. Now what is amount payable by the customer? You will write the spot rate, you will put 50 and another date, and you will get a cancellation loss. No, that is the amount the customer has to pay. Whatever is the, not the effective loss, whatever is the cancellation loss, that amount the customer has to pay on the due date. Till now, any doubts? It can be a gain, it can be a loss. Mostly the problem will be given in a loss scenario. So on the day on which the customer appears, I have to pay this amount. Any doubts till now?
Why not the effective loss? Because he has come after the due date, so you don't have another contract.
No, he may take another contract. He may take another contract. That's another scenario altogether. I'm not bothered. See, even in a practical world, even for this problem which you are seeing here, what the customer will be paying on the date of cancellation is only 25 paise. But what we are saying is effectively you will gain 25 paise. Why? Because your new contract is at 49.5. Old contract was at 50. So you save 50 paise in that process. Payment on the due date, he has to pay 25 paise. Whenever the cancellation is given effect, on that day he has to pay 25 paise. But I'm just telling them the loss is not 25 paise. You are in fact gaining 25 paise because your new contract is at a lower rate. That is the perspective we are giving in that question. So your cancellation amount payable by the customer is difference between the original customer rate and cancellation rate as calculated above. Any doubts on this? Next comes the third point called a swap loss. Now let me explain what is swap loss. What will happen is March 31, I'll say I will buy dollars at 65. I'll buy dollars at 65. So the bank has to sell it to me at 65. I went to the bank, I told this. The moment the bank enters this was delivery on June 30. This is with ICICI Bank, okay? On the moment you agree at 65, ICICI Bank will call Stancy and say that I want to enter into a contract to buy dollars from you at the rate of 64.5 or 64.8, 64.9. Basically the difference is his profit. So you have told that you are going to buy it from me at the rate of 65. I am ICICI Bank. Immediately I am going to enter into another contract with some other bank. So ICICI March 31 buy at the rate of 64.8. Buy at the rate of 64.8. You will buy from me at the rate of 65. I'll buy from someone at the rate of 64.8. In this process, 20 paisa is my profit. Everything done, close. Suddenly you are not seen on June 30. You are not there on June 30. I cannot say no to Standard Chartered because ICICI is not expected to default on its obligation. So it has to honor its commitment with the other bank at least on that date. I have to honor my commitment on that date. So what I tell, I go to the Stancy and say that, see, I have wanted to buy from you at the rate of 64.8 because somebody was to buy from me at the rate of 65. I'm not able to find the customer. So let's do one thing. Let's extend this contract to July 30. Practically what they say is the banker has to extend it to the next available contract. The banker has to extend it to the next available contract. When I extend to the next available contract, in this process, my effective rate of 64.80, that is, originally I was to buy at 64.80, now I have to cancel, I have to enter a new contract. In this process, my rate can even go up to 65.25 or 65.45. Then what happens is I may start losing money. The banker is worried about it because, see, the point is you did not come on June 30. When you have not come on June 30, Stancy is not ready to listen to anything. So to Stancy, I say, cancel new contract. Cancel a new contract. Why I am entering into a new contract? Because I don't know, you may suddenly appear on July 5 or you may suddenly come on July 10. Because of that, I at least have to enter into a new contract. I cannot be saying I am not entering into a contract. So I may enter into a new contract, and if the new contract pushes up the rate, the difference in that rate is my swap loss. That is my swap loss, and I am going to again recover it from the customer. I'm going to again recover this money from the customer. So the customer has to pay me another 45 paise. 65.25 minus 64.80. I'll tell the customer, you please pay me another 45 paise. Any doubts till now? Any doubts till now? This is because, so how the calculation will be done? It will be done exactly the same way. You will write date, position, action, reference date, rate, all this from ICICI Bank's point of view. This is ICICI and Stancy, they are talking to each other. ICICI says March 31, I had agreed on buying at the rate of 50. On June 30, let's cancel at the rate of 48.7. I will pay you 1 rupee 30 paise. Then new contract I will enter into. My effective loss is 1 rupee 1 paise. This effective loss of 1 rupee 1 paise which you see will be recovered from the customer. Customer has to pay me this 1 rupee 1 paise. Why customer? Because otherwise this transaction itself can become a loss making. But will I be paying 1 rupee 1 paise to the Stancy? No. I'll be paying 1 rupee 30 paise. And why it is 1 rupee 1 paise? Because my new contract is at a lower rate. Be very careful. Cancellation loss is an outflow. Effective loss is the real loss, assuming all other transactions fall in place. Assuming you buy and sell, everything happens. Your cancellation loss is not the actual loss, but that money has to be paid. Effective loss is the actual loss, but that money is not required to be paid on the date of cancellation. So this is the amount I will recover, but this is the amount I'll pay. This is the amount I'll pay. On this amount which I pay, for the number of days the customer is disappearing, I will charge interest. Because I have paid, but I am yet to get the money from the customer. Why did I pay? Because my customer did not come. Otherwise, I wouldn't have paid this money. So for the same format, the format remains the same. You will exactly do the same format. For the number of days of disappearance, so interest cost is equal to 1.3 into $2 lakh into 10 days, 5 days, 6 days, 15 days into whatever is the rate of interest. So for that number of days, I will charge interest. But what is loss? Loss is 1 rupee 1 paise into 2 lakh. That is my effective loss. Any doubts in this? So it is an amount paid by the bank due to cancellation. Bank generally does a swap by taking one transaction in the spot and taking cover by a reverse position in the immediate forward rate. All this is done on due date. Interest. Bank will charge interest to the customer on the cancellation charges paid. It is calculated on the bank's original covered rate and the reverse date. Interest is calculated for the period of disappearance of the customer from the due date. What I'll finally recover? I'll recover all of this. cancellation charges, swap loss, interest on outlay of funds. You pay all of this first when you come on July 10, and now tell me what you want to do. You want to honor your commitment? Honor at the spot rate. If you are saying you want to honor your commitment, you'll have to honor it at the spot rate. If you are saying you're going to extend the contract, let's extend from this date. If you want to cancel it, pay me this amount and done. So all this amount anyway has to be paid. After paying, if you say cancellation, everything is closed. If you say honor, then pay whatever is the spot rate. Pay or receive from me, whatever. If you are giving me dollars, I'll pay you. If you are getting dollars from me, you pay me the amount on the due date, if you are honoring your commitment. If you are asking for extension, I'll calculate the extension rate. Clear? Any doubts on this? Any doubts on this? This question has come 3-4 times in exams, an extremely important question. Let me know when I do the problem, you'll understand there can be a little bit of difficulty. Till now, any doubts anywhere? The only one departure which I am doing from the general rule is cancellation rate refers to the rate on the date on which the customer appears and not the originally contracted date. I have till now kept on saying on June 30, what is the rate for June 30? I kept on matching the date. But on July 10, I cannot find the rate for June 30 because this guy didn't come on the due date. He is coming later and I cannot go back and calculate this. Clear? Practically, will all of this happen? I doubt this will happen, because if the customer is not appearing on the due date, I'll just call the customer and get to know what is happening. If I'm not able to contact the customer on that date, then it means the customer is not going to even come at all. He has disappeared permanently. That is what can happen, because it is not that there could be a temporary disappearance in a practical world, because I can easily find my customer, or at least the customer will say that let's extend it for 5 days, 10 days, whatever it is, the customer will talk about it. Because practically I don't see this scenario panning out. That's my understanding. Exactly how it works in Forex, I'm not very sure, but my understanding is practically this may not happen. Clear? But from problem solving, it has come multiple times, so we'll do 2 problems on this. Okay, let's read through question 15. An importer booked a forward contract with his bank on 10th April for USD 2 lakh at the rate of 64.4. The bank covered himself at the rate of, I'll keep reading and explaining, at the rate of 64.28. So what the bank was doing is, bank will sell at 64.4 and bank will buy at the rate of 64.28, make a small profit of 12 paise. I was very happy with all of this. The exchange rates are given here. This is an exam question. This is the rates given. Exchange margin, interest. Importer requested on 20th June for extension of contract with due date on 10th August. Rates rounded off to decimals and multiples of 0.0025. On 10th June, that is on the due date, the bank swaps by selling spot and buying 1 month forward. This information need not be given. If the problem is silent also, this only will happen. He has to cancel and take the immediately available contract. Cancel, take the immediately available contract. Calculate all of this. Cancellation rate, amount payable, swap loss, interest and outlay of funds, new contract rate and total cost. Can we start? Calculation of cancellation rate. Calculation of cancellation rate. We will put it in this format, but there will be certain adjustments to be done. It's not that I'm going to change the format, I'm going to use the same format. Calculation of cancellation rate. On what date did I enter into contract? April 10. April 10. Original is for what? Buy, in bracket ask. How many months forward it was? It was for 10th June. Okay, June 10. It was for June 10. At what rate did we agree? 64 point. 64.28 is by the bank. That is ICICI doing with stand C. With us, it is 64.4. It says bank covered itself. Why did bank cover? To ensure that they make profits. Now, he did not come on June 10. He has come on which date? June 20. June 20. Opposite. Opposite. Sell in bracket bid. Sell in bracket bid. And now the departure from the rule. I am going to write here June 20. I normally don't do this. I ensure that I write the same date. But on June 20, I cannot be asking you June 10's rate. On June 20, what is the bid rate for June 20? Read it and let me know. On June 20, what is the bid rate for June 20? 60. I'll explain what are this in some time. Let's focus only on the spot rate. There is some issue with the question. I'll explain in some time. Let's not worry about spot June, July, August. Spot USD one. Just look at the first row. 63.68. You have to take care of the exchange margin. What you will do with the exchange margin? 63.68. See, ignore these rates for the time being. I'll explain it in some time. I'm telling you to ignore. There is some issue. I'll explain that issue in some time. You just focus on the first rate given in the question. Minus 0.1%. So 63.68 minus 0.1%. Don't write that. Minus 0.1%. You get how much? 63.6163. The question says it has to be multiple of 0025. So the last third and the fourth digit has to be 25, 50, 75, 00. Multiples of 25. It has to be either 25 or 50 or 75 or 00. Which is closer? 75. So we'll make it a 63.6175. 63.6175. The last two digits has to be either 25, 50, 75 or 00. So we will make it a 63.6175. $63.6175. All this is custom. Yeah. ठीक है, let it be. So I take that to be the proxy for the rates. So that is where that extra 0.1% comes into picture. That extra 0.1% will take care of it. So with another bank, I may enter into these rates. So when I'm going to do bankers analysis, I'll use exactly the same rates. I'm not going to take care of the margin part. So the margin may be the extra margin for the banker. Now we are done with part 1 of the question. Part 1 cancellation rate is 63.6175. The cancellation rate is 63.6175. Any doubts on 63.6175? Amount payable is basically this, okay? This into 2 lakhs. This is the amount I have to pay. There are other amounts to be paid, but this is one of the amount to be paid. See, it is more or less same as the earlier analysis, except the reference date part. I have not followed the rule which I have been talking till now. I have changed the rule a little. So amount payable is 156. Any doubts on 156,500? Okay. Now I'm going to shift to the swap loss part and the other parts. Any doubts on this? Any doubts? Now listen, the problem which I technically have in this issue, they've said spot USD1 and they've said spot June. There can't be two spot rates. You cannot be having two spot rates. So my ideal understanding is this could be June 30 rate. Could be June 30 rate or could be a rate which is of no use. I'm not very sure, and I'll tell you what institute has done, but every problem they've asked exam this way only. They have made it like this only. So this could technically be the forward rate for June 30, forward rate for July 30, forward rate for August 30, forward rate for September 30. Could be. I'm still not very sure on that. Could be this interpretation, but 3 times it has come in exam and 3 times it has been repeated like this only. So I'm not sure whether there's an issue with my understanding, but whatever I have understood, they have kept on asking the same part. So maybe the interpretation is June 30, July 30, August 30, September 30. This is June 10. This is June 20. June 10 and June 20. And then June 30, July 30, August 30 and September 30. Maybe that's the kind of interpretation they could have taken. But there also there is certain issue, so I'll keep coming to the issue in some time. Now to calculate the swap loss, now after doing customers analysis, we'll do bank analysis. We'll do bank analysis. We'll do bank analysis. Now, when it comes to bank analysis, you will have to now talk between ICICI and Stancy. Don't bring the customer in between. ICICI, the base bank which we are analyzing, whether it was to buy dollars or sell dollars from another bank. It was to buy dollars and sell it to us. So, original April 10. $64.28. April 10 original buy ask, June 10 64.28. Any doubts on 64.28? Now my customer though doesn't come on June 10, I cannot be saying a no to the other bank. So what will happen is June 10 opposite sell for June 10. On June 10, what is the bid rate for June 10? Listen for a minute. This bank, when you analyze, this bank is technically a customer to another bank. He is technically a customer to another bank, so it is like a customer itself. It's like a customer. I cannot say the bank is buying, so will it bank is selling, will it happen at the ask rate? Nothing of that sort. He is like a customer to the another bank. I've told you, whenever one bank deals with another bank, one of them becomes a customer, other person becomes a seller, and accordingly the rule will follow. So on June 10, what is the bid rate for June 10? On June 10, what is the bid rate for June 10? 63.8, no 0.1 percentage and all, that is only applicable to the end customer. So 63.80. 63.80. Any doubts till now? Now why I cancelled this is because my customer did not appear, but I cannot be keeping quiet. The rules say that I'll have to take the next available forward contract. Listen for a minute. On June 10, new, I'll have to enter into a new, again buy ask, and the available contract I assume is June 30, the next line item. Whatever is the next line item available, from there I'll take the next available contract. What is the ask rate in the next line? 63 point. You cannot be looking at this rates because you are analyzing on June 10. We are only on June 10. So this is the rate I'll have to take. The next available line, the only issue I face in this question is they should have ideally made it a little better. They shouldn't have given the June rate. They could have made it as July 10, August 10, September 10, or July 20, August 20. It would have made more sense for us. But I'll follow whatever the institute says. the only thing which I want to say is you will have to cancel and take the next available contract. When you are doing all of this, don't go and check June 20 date, because you are doing all of this on June 10, because to my bank on June 10 I have to honor my commitment. To the customer may honor, not honor, because customer I'm not able to trace him, but obviously Stan C is going to trace ICICI and ask what are you doing. So on June 10, listen for a minute, on June 10 I cancel and I then enter into, listen for some time, I'll tell you when to note it down, 63.95 effective rate is this. Now what is the problem for me is, originally my effective rate was 64.28 and I was to give it to you at 64.4. I was very happy. But now suddenly you are saying you have to give 64.43. I'm not happy with it, because I'll start reporting losses. So what is going to happen is, what we call as effective loss is called a swap loss. What we call as effective loss is called a swap loss, and that swap loss is 15 paise. That swap loss has to be paid by my customer. That swap loss has, I'll tell you to note it down in some time. Swap loss has to be paid by the customer, 15 paise into 2 lakh, and he has to pay interest. Though my loss is 15 paise, Stancy will say pay 48 paise now. Why 48 paise? Cancellation loss. Why swap is only 15 paise? Because the new contract is at a lower rate. Clear? Any doubts on this? Your new contract is at 63.95. Old contract was at 64.28. Yeah.
The customer will ultimately pay the cancellation loss of 0.48.
Customer?
Will ultimately, the ICICI bank, whatever the case may be, will collect the cancellation loss and not the effective loss.
Why he will not collect the cancellation losses? Because he is not losing 48 paise. His calculation was 64.28, 64.40. Now his calculation is 64.43. He wants 64.55 from the customer. 64.55, extra 15 paise. I need only extra 15 paise. But what am I going to do with that 48 paise? I'll collect interest from you. Yeah, tell me.
Explain the bank analysis. So what is the bank doing on June 10th?
Okay, you have understood till 156,500. That is your customer analysis. On June 10, bank has to cancel his contract. Bank A has to cancel its contract with Bank B and enter into a new contract for June 30. This is what he has to do. He has to cancel his original contract on June 10 itself. He cannot be waiting till June 20. Cancel. Bank, yeah. Bank, okay, let me make it like Bank A has to cancel its contract on June 10 and enter into a new contract for June 30. Bank A does not have an option of disappearing. Whereas the customer was disappearing, Bank A doesn't have a flexibility. He has to either honor or cancel. What I am doing is I am cancelling and getting a new contract, because I don't know, this person may come in between. So I'm not very sure and whether he comes, he doesn't come. So if he comes in between, what to do? So because of that, I enter into a new contract. Clear till now? So on April 10, I had entered into a contract at the rate of 64.28. Bank A with Bank B. Ignore customer for the time being. Don't bring customer into picture for the time being. Now on June 10, Bank A has to cancel its contract. Clear? It'll have, the cancellation will happen at the bid rate, because your original was the ask rate. After cancellation, I'll enter into a new contract for the next available forward rate. The next available forward rate is June 30. The next available rate is June 30. So I entered into that contract. I had to pay 48 paise. Bank A has to pay 48 paise to Bank B, but they effectively lose only 15 paise. They effectively lose only 15 paise. We have been writing this effective loss, cancellation loss, effective loss, cancellation loss. I have been telling you cancellation loss is an outflow, effective loss is a real loss. Effective loss is the real loss. So what will happen is, I have to pay 0.48 into 2 lakh. Bank A has to pay to Bank B. Bank A will not keep quiet. Into, when does the customer come? June 20. He's disappeared for 10 days. For 10 days I'll charge interest. He has disappeared for 10 days. For 10 days, he'll charge interest at what rate? This is the interest he has to pay. Whatever is the amount bank A is paying to bank B, whatever amount bank A is paying to bank B, I will charge interest on that. I am not going to collect that money from my customer because that's not my loss. I am making it again very clear. Cancellation loss is not the real loss for the company. Swap loss or the effective loss is the real loss for the bank. So bank is not interested in 48 paise. Bank is interested only in 15 paise. Sometimes 48 paise will be the cancellation. Effective can be 1 rupee 48 paise. I'll collect 1 rupee 48 paise. I'll collect 1 rupee 48 paise from the customer. Whatever is my effective loss, I need that. If effective loss is 2 rupees, pay me 2 rupees. If effective loss is 1 rupee, pay me 1 rupee. But to the other bank, bank A has to pay the cancellation loss. On that he has to charge interest. Any doubts on this? So if I give sequence of event will be like this. On April 10, let me call it as, okay, on April 10, importer goes to bank A, takes a forward contract at the rate of 64.4. Bank says, wait, you have come. He calls, practically this is what happened. He will not call, practically you will see the rate. Bank A will call bank B and enter into a forward contract at the rate of 64.28 and immediately close 64.40. This is on April 10. June 10, not able to find the importer. Bank A will cancel its contract on June 10 with bank B. After cancellation, I will have to pay 96,000. The moment I cancel it, I will have to pay 96,000. After paying 96,000, I will tell I am entering into another contract for June 30 at the rate of 63.95. Clear? Any doubts in this? This increases my effective rate. So banker has told, let the customer come, we will collect 15 paise from the customer. I made my mind very clear because my original rate was 64.28. Because of this person, my rate has gone up to 64.43. So I made my mind that I'll collect 15 paise. I'll also collect interest. Suddenly the customer comes on June 20. First I say, pay me 96,000. Then I say, pay me 30,000 swap loss. 15 paise into whatever it is, pay me that. Second thing, pay me interest. Third thing, pay me 156,500, and then I say what you want to do. You tell me what you want to do. You want to honor your commitment, cancel your commitment, extend your commitment. Let's discuss on all of that. First you pay 156,500, pay 30,000, pay interest. Able to understand this? Clear? This is the simplest way I can explain. Still there are doubts, I'll explain again. I don't have an issue in explaining this point again because this keeps coming in exam. So wherever there is an understanding gap, I have tried to make it in the sequence like a story. Still there are doubts, let me know. Anywhere there is a doubt or you want an extra explanation, again the entire thing to be explained, I'll explain again. Clear? Can we proceed? So this amount, what I have calculated here is the interest. So the customer has to pay interest of 316, has to pay swap loss of 30,000, has to pay cancellation loss of 156,500. So done. Total cost is adding all of this. New contract rate will come to in some time. Any doubts till now? Any doubts in this? Clear? Now do this bank analysis. Who is a customer to another bank? Yeah.
This guy is coming on June 20 itself, and then I have entered into a contract with bank B till June 30. So since I am getting the money on June 20 itself, and I'll again cancel the contract with bank.
That is bank's responsibility. So bank will cancel it and bank has to absorb that loss.
That cancellation loss will not be considered.
Now the point is how it will practically work is on June 20 when I cancel, technically a cancellation will happen at the spot rate. And the spot rate is the rate at which I am dealing with my customer. So technically I will not be losing anything. So in one transaction I will lose, in other transaction I will gain. So effectively I am not bothered about it. In fact, the customer can even appear and say 2 months. He can extension for 2 months, 5 months, he can come and say anything. The moment he comes, I'll cancel my contract. Why I'll cancel my contract is already the cancellation has happened with customer. I'll cancel it with the other bank. Whatever he says, I'll also do the same thing with some other bank. immediately. All practically both will happen together in matter of seconds. Both will happen together in matter of seconds. Nobody goes to the bank. It's either through phone or at times it's even through the software. It can be even through a software also or through phone. I call and say that, see, practically what happens is, I'll call the bank and say, what is the rate? He'll say 63.95. Why will he say 63.95? He would have seen 63.80 rate to be there. He'll say 63.95. He says, okay. The moment he says, okay, I'll put 2 okay and close it. One okay for 63.95, other okay is for 63.80. In this process, I make my 15 paise. The basic rule is banker is not expected to speculate. Banker should make money only by this difference of 10 paise, 20 paise rather than speculating. Speculation can give profit as well as loss. Any doubts on this? So cancellation rate is done, cancellation loss is done, swap loss, interest, and any doubts on swap loss part? Anybody needs an explanation? We are going to do the same thing in the next question also. Anybody? Swap loss. Basically it is called swap loss because you're swapping your June 10 contract with June 30 contract. You're swapping the June 10 contract with June 30. You're swapping the date from June 10 and taking it to June 30. Even if you read the question, says somewhere, swaps by selling spot and buying 1 month forward. They do a swap by doing spot and 1 month forward. Any doubts on this? Now total cost equal to 156,500 plus 30,000 plus 316. 156,500 plus 30,000 plus 316. 186. Any doubts now? Any doubts till now? He will not pay 96,000. 96,000 interest. That's not a loss. No. Again, I am telling you, 96,000 is not. Yes, correct. Bank A has to pay to Bank B, but Bank A is not losing 96. Bank A is losing only 30,000. The loss is only 30,000, but payment is 96,000. Any doubts on this? Can we proceed? Okay. Now, the last part, where again there is a little bit of an issue with the question. With due date on what he wants to extend? 10th August. Now please listen. Institute have straight away gone ahead and taken this date. Institute has gone ahead and straight away taken this rate of August. Taken this rate of August. On June 20, I come and I say that I need an extension till August 10. So that new contract rate will be August rate. Before this, I was explaining that it is June 30, July 30, August 30, September 30. If I don't take that assumption, I will not be in a position to do the part 2 of the question, that swap loss wala part. Institute for this part, they have said August means August 10. August means August 10. So this alone is a technical issue, because if you have to take an August 10 contract and you don't have that, then you will ideally take July 31, whichever is closer. For an August 10, I'll take the closest contract date. If you don't have an August 10, take July 31 rather than August 31. Practically, that is what you should do. Closest available date, which I'm not sure what interpretation at all to be taken. If I take it as 30, 30, 30, that's an issue there. So, one thing alone you remember when in an exam problem, for swap loss, just take the second rate and swap it. Just take whatever is the next available date and do the swap loss part calculation. For the new rate, if it's August 10, go to the August month and take the date. If it is July 10, take the July rate. If it's September 10, take the September rate. Clear? Any doubts in this? So now write new contract date equal to 64.25 plus 0.1%. $64.25. Any doubts on 64.25? You have to ignore this June 10 rates itself and see only June 20. All your analysis has to be only with June 20 rate. From that rate, what I see is for the month of August, the rate is 64.25. Add 0.1% and tell me how much. 64.31 multiples of 0025. Multiples of 0025. 64 point rounded off to 64.3150. Any doubts on this? We'll do one more problem so that it becomes a little better. The understanding is better. Any doubts on this? Here they have asked for new contract. Sometimes they may ask for cancellation or extension or honor, which we are going to see in the next question. Any doubts till now? Any doubts? I'll again explain the steps. Cancellation rate and amount payable, customer analysis. Swap loss interest, banker analysis. Add both, that's the total cost. New contract rate, whatever we have explained till now. That is nothing new for you guys. Go through question 16. Now let's try to understand the question. On 10th July, customer said 66.84. Immediately bank A went to bank B. Bank A went to bank B and booked at what rate? 66.68. He comes on 20th September. He doesn't come on 10th September. He comes on 20th September and says three things. Cancel it. Whatever total cost we get, that's the problem ends. Execute means it will execute at the spot rate. Extend the contract means you have to take a new contract. So three parts to the solution, either cancellation, execution or extension. The exchange rates are given as under. Exchange margin. You are required to show calculations for cancellation, execution and extension. For all these three to be done, first I'll have to calculate those items and get the total cost. Cancellation rate, cancellation loss, swap loss, interest cost, total cost. Let me get all those 5 things and then we come to what is required in the question. So working note 1, calculation of cancellation rate, calculation of cancellation rate and cancellation loss. Calculation of cancellation rate and cancellation loss. Calculation of cancellation rate and cancellation loss. Customer analysis with those 5 columns. Customer analysis with all those 5 columns. What was the date in which the customer came? July 10. Original. July 10 original. What action did he take? Buy in bracket ask. For which date? September 10. At what rate? 66 minus 66.84 minus 66.84. Now he suddenly comes. The due date is gone. He did not come. He came on which date? September 20. September 20. It is going to be opposite. Sell in bracket bid. Opposite sell in bracket bid. What will be the reference date? Ideally should be September 10, but can't help it because he has come on September 20. So on September 20, what is the bid rate for September 20? 65 point. Adjust that percentage, 1%. 4 decimal answer. You'll have to deduct that exchange margin. 65.8940. 65.8940. So the banker will ask the customer to pay 47,300. First thing, the moment he appears, first he has to pay 47,300. $47,300. After this, we are going to do banker's analysis. Banker analysis. This banker is going to deal with some other bank and do all these transactions. He's going to deal with some other bank and do these transactions. On July 10, what is the rate he agreed on? 66.68. 66.68. He doesn't have an option of not honoring his commitment and all. Any doubts on 66.68? You try to fill this table. I'll check the answer. Try to fill this table. only on September 20. Now, any doubts on this? The total cost which the customer has to pay 87 plus 8,500 plus 47,300. So he has to pay this amount 55,887. Now we'll see the different scenarios which they're talking about, but he has to pay 55,887. That amount has to be paid 55,887. See, always what has to be taken is the next available contract. Now I'll tell you a shorter way of getting the swap loss. It's a quicker way of getting a swap losses, but for interest obviously I need to do that calculation. Swap loss is this: you are swapping 66.15 with 66.32, 17 paise difference. You are swapping 66.15 with 66.32, that is a 17 paise difference, or you are swapping 66.28 with 66.17, depending on whether it's an importer or exporter. Depending on what you are doing, you are swapping one bid rate with the other ask rate. That is what you do. Last problem, we were swapping 63.80 with 63.95, 15 paise loss. 63.80 with 63.95. But for interest calculation, I'll have to show that part. Interest, I can't do much about it. Swap loss, if I want straight away, I can do this. Swapping 66.15 with 66.32. So this is the swap we had done. 66.12 with 66.32, 17 paise loss, 8,500. Now come down. Scenario 1, cancellation of contract. Scenario 1, cancellation of contract. Scenario 1, cancellation of contract. The customer has to pay cancellation charges. The customer has to pay cancellation charges of rupees, how much we have decided? 55,000 all put together. Cancellation charges of rupees 55,887. Of rupees 55,887. Rupees 55,887. Clear? Scenario 2, execution of contract. In that point number 8, the customer has to pay cancellation charges of 55,887. The customer has to pay cancellation charges of rupees 55,887. $55,887 for cancellation. Next point, for purchasing $50,000. For purchasing $50,000, he has to pay. He wants to execute. That is, he wants to buy $50,000. He has to pay 50,000 into. What is the spot ask rate? 65.99. No. 65.99 plus 0.1%. 65.99. He is coming on September 20. Okay, not coming on September 10. 65.99 plus 0.1%. Plus 0.1% and multiply that with 50,000. This amount he has to pay 33,02,800 broadly. 65.99 plus 0.1%, which will be 66.056. $33,02,800. Any doubts on this? Scenario 3, extension of contract. Scenario 3, extension of contract. Extension of contract. The customer has to pay cancellation charges of 55,000, whatever number. Customer has to pay cancellation charges of rupees 55,000, 55,887. Cancellation charges of rupees 55,887. $55,887. Next point, he will enter into a new contract. He will enter into a new contract for November 10. He will enter into a new contract for November 10. For November 10, and the rate for the same, would be 66.49. Rate for the same would be 66.49 plus 0.1%. 66.49 plus 0.1%, 4 decimal answer. 66.5565. 0.5565. Clear? Any doubts in this? Anybody has any doubts in this? I'll note down the summary now for this area. With that, we'll end today's session. From tomorrow onwards, I'll shift to areas other than international finance. We'll come back to international finance only once the derivatives are done, because I can explain topic 53, 54, 55 only with derivatives. MMH is a small area. Wherever we get time in between, we'll do MMH and other areas. Now go to the last few pages. Topic 50, forward contract. Topic 50, forward contract. Yeah.
He is actually not coming. The customer is not coming. Is it compulsory that I have to cancel what contract I have entered with the second bank, or I can pay the actual amount and charge the entire interest from the customer?
No, so you will not pay the entire amount because you don't know whether the customer would need. So assume you have paid the entire amount. You will have dollars with you. You will get the dollars. Customer on the due date says, I don't want dollars. You can charge interest, but he's not ready to get money. So dollars will again be stuck with me. So you will either cancel it, basically you will extend it. You are extending it. That's the rules. The rules also say extend it to the next available contract. Question number 1. Point number 1. Forward contract is one of the tools. Forward contract is one of the tools to protect a company from the currency risk. To protect a company from the currency risk. To protect a company from the currency risk. Next point. Total commitment in rupees equal to USD payable into 6-month forward rate. USD payable into 6-month forward rate. USD payable into 6-month forward rate. Next point. 6-month LIBOR of 2%. 6-month LIBOR of 2%. 6-month LIBOR of 2% would basically mean 6-month LIBOR of 2% would basically mean that the interest rate is 2% per annum. 6-month LIBOR of 2% would basically mean that the interest rate is 2% per annum. Question number 2. profit, okay, first contracted forward rate equal to contracted forward rate equal to contracted forward rate equal to forward rate equal to forward rate plus upfront premium plus upfront premium plus interest on upfront premium plus upfront premium plus interest on upfront premium plus interest on upfront premium. Profit slash loss equal to amount payable in spot market minus amount payable in forward market. Amount payable in spot market minus amount payable in forward market. Next, question number 3. The current spot rate is 108 yen equal to rupees 30. Full stop. It is given that exchange rate will decline. And the importer is expected to report losses. Full stop. This is possible only if my liability in bracket N appreciates, and consequently the rupee will depreciate. Question number 4. Consequently the rupee will depreciate. Question number 4. Expected spot rate equal to weighted average of the various rates with probability being the assigned weight. Question number 5. Forward rate will be calculated as per IRPT. Next, profit slash loss equal to amount payable in spot market minus amount payable in forward market. Next, center of the page write forward contract and split it into 3. Honor cancellation extension. For all these 3, below 3 points for all of them. Before due date, on due date, after due date. Before due date, on due date, after due date. Before due date, on due date, after due date. Next point, out of the possible 9 ways, honoring on due date only involves honor, and everything else will involve cancellation. Next, format for calculating cancellation gain or loss. 5 columns. What are those? Date, position, action, reference date, rate. Reference date and rate. Below that, the explanation to each of this. Date equal to date on which the transaction happens. Position equal to original / opposite / new. Action equal to buy in bracket ask / sell in bracket bid. Reference date, date for which the transaction happens. Rate equal to bid / ask rate, in bracket as per column 3, bid / ask rate as per column 3, close brackets, on the transaction date, in bracket column 1, for the reference date, in bracket column 4. Question number 6, no special adjustment. Question number 7, bank has entered into a forward purchase contract. Has entered into a forward purchase contract, and hence the customer has entered into a sale contract. Question number 8. Exchange margin of 0.1%. 0.1% will be deducted from bid rate, and will be added to ask rate. Full stop. This margin will not be applicable for the Singapore market. This margin will not be applicable for the Singapore market rate. will not be applicable for the Singapore market rate. Question 9. We need to consider interest income slash interest saving. We need to consider interest income slash interest saving for receipt of money in month 2. For receipt of money in month 2. For receipt of money in month 2. Question 10, 11, 12, no special adjustment. Question 10, 11, 12, no special adjustment. Question 13. Margin money is given for buying rate and selling rate. Margin money is given for buying rate and selling rate. We will have to interpret this as either on bankers buying and selling rate, either on bankers buying slash selling rate, or customers buying slash selling rate, Next point, cost to the importer for extension equal to loss due to the extension is equal to loss due to the extension. Hyphen, we will have to write cancellation loss. We will have to write cancellation loss as well as effective loss. Cancellation loss as well as effective loss. Question 14, no special adjustment. Question 15 and 16. Cancellation rate hyphen relevant rate on the date on which customer appears to the bank. Swap loss equal to effective loss of the banker due to swapping of original contract with the next available contract. With the next available contract. Then interest on outlay of funds equal to amount payable by the banker to another bank. Due to swapping. Payable by the banker to another bank due to swapping into number of days of disappearance by 365 into interest rate. Clear? with this we'll end today's session. We'll continue in the next class with other areas.